Thank you, Sarah. Money Tuesday, Stewart Welch from the Welch Group joins us, and we're asking the question, when is the best time to invest? How long should you invest? Some very interesting data to show you the facts are the facts. So first of all, I know the stock market's been volatile, but we know that over time, if you stay with it, the long haul, you're going to make money, right?
Well, stocks make money over the long term. Short term, they're kind of unpredictable, but you kind of stay with it. And what we did was come up with a couple of strategies, and the first strategy is invest early in life. And so I took two, let's take the tale of two brothers.
Okay.
So one of them's 19, he's going to invest in his Roth IRA, $5,500 a year, and he does it for 10 years.
Just 10 years?
Just 10 years. He starts at 19, does it 10 years, he's invested $55,000.
Okay.
His brother says, you know what, I'm going to wait. He starts at 29, but invests all the way to age 65. Now, Mike, who do you think ended up with most money?
Well, you would think the guy who was investing it all the way to 65.
Yeah, he put in over $200,000, but here's what happened. At 65, the one that started early had $1,484,000.
Wow.
And the one that started late had $1,002,000. So he put in basically $150,000 more dollars and ended up with about $200,000 less money.
So the lesson there is start early. Just start.
Early. Yeah. Just get started.
Get started.
As early as you can.
Right. And the other thing is you mentioned invest early in the year. You got a few tips here. One of them is invest early in the year. Why is that?
Oh, so invest early in the year. Let's take another tale of two brothers. We'll make them twins. They're 25. They're both going to invest $5,500 a year into their Roth. Excuse me. But the first one is the smartest brother. He's going to invest in January, and the other brother is going to wait until December, which is what most people do. In fact, they wait until April of the next year in order to invest. And so what happens at 65? At 65, the brother that started at the beginning of the year ends up with $1,688,000.
Wow.
And the brother that waits till the end of the year ends up with a lot of money, $1,544,000, but it's $124,000 difference.
Okay.
Just a little bonus for starting early.
Now, why is that, though?
It has to do with compound interest.
Okay.
So both of these examples have to do with compounding. So when people are investing, they think in terms of linear, money's going to grow in kind of a straight line, but that line bends because of compounding. So the longer you're in that curve, the straighter that curve begins to
Okay, and you also talk about prioritizing your investment strategies. What do you mean by that?
So here's a great example. I had somebody come in and they said, I looked at it and said, why are you not investing in your 401k? Because their company matched dollar for dollar. And this person said, I can't afford to. So I looked at what they were doing, and they were investing in a cash value life insurance policy, and they had a personal mutual fund program. So they were in the game. They were doing something. I showed them how much more money they made if they did the 401k, because when they invested in the 401k, they got 100% return in year one. And a quick example is if you took $10,000 invested in a 401k versus taking it after tax, at age 65, you end up with $4 million in the 401k versus $1.5 million in the after-tax plan.
The lesson there is if you may say you can't afford to, you can't afford not to.
Well, and I think the big lesson for all of these people was they were all smart because they all invested. They all ended up with a lot of money.
All right, good tips. Thank you, Stewart. Appreciate it.
Thanks, Mike.
All right, entertainment news regarding